Good morning. Today we are going to start with the chapter number 1, Introduction to Auditing, and we'll see today the basics of auditing, what is the meaning of audit, and how it all started. The word audit is derived from actually the Latin word audio, which means to hear. Because what used to happen earlier, that there was no books of accounts in writing at the start, and so whenever the records of various transactions and assets are to be checked or approved, it was done only after they were heard by a person, right? That since the auditor used to hear the accounts for detection and reduction of errors and frauds, the process of examination of records is been known as auditing, and the person conducting the review is called as auditor, right? So what evolved the auditing, that whenever or we can say at the start of 19th century, the auditing became a necessary part of business. So the industrial revolution in the England in the 18th century led to expansion in production, and the need for huge capital led to emergence of joint stock companies, the form of business in which there exists a divorce between ownership and management. This shareholders' money is managed by the board of directors, who look into day-to-day affairs of the company. And since the owners of corporation were not the ones making the day-to-day business decisions, they demanded assurance that the managers were providing reliable accounting information. And the auditing professionals developed to meet this growing need. Auditing, friends, is nothing but the verification of financial position as disclosed by financial statements. It is an examination of accounts to ascertain whether the financial statements give a true and fair view of financial position and profit and loss of the business. Auditing is nothing but the intelligent and critical test of accuracy, adequacy, and dependability of accounting data and accounting statements. With this part, now we'll move to the definition of auditing. Here are few definitions given by various economists. The first one is by L.R. Dixie, which states auditing is an examination of accounting records. Right, so auditing is nothing but an examination. An examination of what? Examination of accounting records. It is undertaken with a view to establishment whether they correctly and completely reflect the transactions to which they purport to relate. Right, so whether those accounting records give or reflect the correctness and completeness of transactions of that particular establishment is called as auditing. One more definition we will see by R.E. Sculpture. Auditing is the systematic examination of financial statements, records, and related operations. Right. So again, they are saying auditing is an examination, but this examination is systematic. And examination of what? The examination of financial statements, that is profit and loss and balance sheet, all other schedules, then records, the books of accounts, and related operations. So operational aspects are also verified. And why this is done? To determine adherence to generally accepted accounting principles, management policies, and stated requirements. Right? All those operations, all those financial statements should adhere to generally accepted accounting principles. They should follow various accounting principles. They should follow management policies decided by the higher management, and various requirements under the law or any other statute which is governing the business. Right, so that is auditing. Auditing means, my friends, examination of financial statements, basically like balance sheet, profit and loss, but it includes the verification of reports, documents, vouchers, etc., on the basis of which finance statements are also prepared. And the auditor now is required to submit his report stating whether the financial statements give a true and fair view of the operating results and financial position of the organization. Such an examination may be undertaken by a business concern or any other organization. So this is what auditing is. Now in the next video we will see the objectives of auditing. So now we'll see the objectives of auditing. Right, the objectives of auditing are changing, of course, with the advancement of business techniques time to time. Earlier, it was about checking the correctness of receipts and payments. It was restricted to, but now it is settled, and those objectives of auditing have been divided under two heads. The first is main objective, or we can call it as primary objective, and second is the secondary objective or subsidiary objective. So coming to first main objective or primary objective, what is that? The primary objective of audit is to give an opinion on the financial statement of the enterprise, expressing whether the financial statements give a true and fair view of the operating results and financial position of that enterprise. Right, so it is about true and fair view of what the operating results. The operating results are also, of course, there in the profit and loss account, and the financial position. The financial position is stated in the balance sheet. Right, so in short, whether those financial statements, that is balance sheet and profit and loss, gives true and fair view. That is the primary objective. Now talking of this true and fair view, prior to say the enactment of Companies Act 1956, the words true and correct were used. True and correct indicated precision. These words emphasize correctness. But in the present day business world, with millions of transactions, it is impossible for the auditor to check each and every transaction. What is required is the application of test check and the subjective opinion of the auditor as to whether the accounts give the fair view of the financial position and performance. So that's why it is true and fair and not true and correct. There is a difference in the words true and correct view and true and fair view. What is correct need not necessarily be fair. For example, if excessive depreciation is provided to one or more of the fixed assets and accounting entries are passed, then we can say the profit and loss and balance sheet are correct. But we cannot say that it is fair, because excessive depreciation would reduce the profit of the company and result into creation of secretive reserves. Right, so it is true and fair view. So this is the primary objective of the auditing, to verify and establish that at a given date, whatever date the balance sheet is prepared, so balance sheet presents true and fair view of the financial position of the business, and the profit and loss account gives the true and fair view of the profit or loss for the accounting period. So this is main objective or primary objective. Second is secondary objective, or we can say subsidiary objective. Now what is this subsidiary objective? It is nothing but detection and prevention of frauds and errors. Right? Errors and frauds are to be detected and prevented if possible. Now these misstatements in the financial statements can be due to error or frauds. So we have to see what is error and what is fraud. Basically, error refers to an unintentional misstatement in the financial statements, including omissions. In general, errors are innocent, but sometimes errors that may appear to be innocent are ultimately found to be due to fraudulent manipulation. So there is very thin line in between error and fraud. But as an auditor, you have to understand whether a particular misstatement, whether it is an error or a fraud. Right. So coming back to error and fraud, error of course is an unintentional misstatement. By mistake one makes the statement and that is wrong, so it is called error. Whereas talking of fraud, the fraud is something different than error. If you go to the definition given by ICI, the term fraud refers to an intentional act by one or more individual among management, employees or third parties involving the use of deception to obtain an unjust or illegal advantage. So what is fraud? Fraud is nothing but fraud is a misstatement in the financial statement, and this misstatement is made intentionally. Who will do this? It is done by generally management or employees or third parties few times. And why it is done? The purpose is to obtain an illegal advantage. Right, so there are four aspects of fraud. That for number one, it should be misstatement. Number two, it should be intentional. Number three, it should be by management, employees or members of third parties sometimes. And lastly, the purpose must be to obtain illegal advantage. Right, so here we have to detect and prevent errors and frauds as an auditor. That is the subsidiary objective or secondary objective of auditing. Of course, this we are going to study in detail at the latter stage, the types of frauds, types of errors. Right, for the timing you have to understand the primary and secondary objectives. Whether the primary objective is to verify true and fair view of the business and its transaction, and the secondary objective is to prevent and detect errors and frauds.